Hi, BK. Thanks.
All right, friends, welcome back. And to end this reading, we have the last module, which is the yield curve risk and economic factors. Three LOSs dedicated to the material, but it is rather short. So let's get started with it. There are three types of changes or shifts in the yield curve. The parallel, which is what we have talked about in level one as well, and non-parallel, which could mean changes in slope, so or changes in steepness of the yield curve, and then finally changes in curvature. So yield curves are curves. straight lines, and so there may be curvature, and that curvature could change. Let's discuss how this impacts portfolio value as the yield curve shifts or changes. Now, to calculate the impact on portfolio value, bond portfolio value, there are three metrics that we could use. Effective duration, our old friend, you have learned this in level one as well. The second one is key rate duration, that's a new metric you're learning. And then finally, looking at a model that captures all three shifts in one equation, in one model. So let's look at the first one, effective duration. Effective duration is simply the change in level of rates. So the parallel shifts in yield curve. Now, this parallel shifts in yield curve explains more than 75% of variation in bond portfolio return. So most important factor is really the level of the yield curve, the changes in level. The problem with this metric though is it does not capture any non-parallel shifts in yield curve. So any non-parallel changes will have to be addressed or will be unexplained by effective duration. So as an alternative, we have other metrics. The next one is key rate duration. Key rate duration is a more sophisticated metric that basically looks at different points along the yield curve and evaluates the sensitivity of portfolio value, bond portfolio value, to changes in specific par rates. So par rates are not spot rates. So par rates are yields, remember, and we already learned about extraction of spot rates from par rates. So par rates are yield or yield to maturity of bonds that are trading at par. So you want to isolate the change in a single par rate, keeping everything else constant. So mathematically, it is a little more involved to be able to do that. So however, our objective here, we'll talk more about the par rate, the key rate duration later on in the next reading, not next reading, but the reading on bonds with embedded options. So once again, key rate is duration is measuring the change of a single par rate, keeping all other par rates equal or constant. So if you identify all the rates that the bond portfolio is sensitive to, then each sensitivity is captured by duration. So in this example, there are three specific par rates that the bond portfolio is sensitive to: 1 year, 10 year, and 20 year. So if those are the three key rate duration, we can add up their key rate duration and it will become, so sum of key rate duration is equal to effective duration. And so if I was to evaluate parallel shifts in yield curve, I can just add up the key rate durations together and multiply the change in yield to get to the estimated impact on the price or value of the portfolio. Now, the model, this originally was developed by Litterman and Scheitman, basically captures these factors in a single model. So the level, steepness, and curvature, all three are captured. Think of it as a regression model that is basically estimated, and instead of betas we use d's. So instead of the beta coefficient lowercase b, we are using uppercase d, but the idea is still the same. They are regression slope coefficients, and each of these duration. metric or beta coefficients measure specific risk factor level, steepness, and curvature. All right, so those are the three ways in which we can evaluate impact of changes in yield curve on a bond portfolio value. Now, let's look at some of the examples from the curriculum. The most important factor and is what? In
Level.
explaining yield curve is found to be what?
Level.
The level. The level is more than 75%. Of change in total yield curve. The second example is the movement along the yield curve in which the short-term rate decreases by 150 basis.
Okay. I've got yield. I've got maturity. I've got my yield curve, which is the original. I've got the new one where the short end decreases by 150 and the long end decreases by 50. So the front end has decreased more. So you've got steepening of the yield curve, but the front came down more. Therefore, bullish steepening. Yeah. Steepening results from changes in level and steepness. Steepening results from changes in steepness and curvature. C.
Long-term rate decreases. Short-term rate, decreases by 150, and long-term decreases by 50. And an important factor in explaining changes in the yield curves has been found to be what? So because the short-term rate is decreasing but more than the long-term, it is not a flattening. It is steepening of the yield curve, and also obviously the change in level. Even both of these rates are decreasing, so the level is also changing as well as slope is changing. Wow. The yield curve is becoming steeper. All right. The third example. Yield curve starts off flat and then intermediate maturity yield decreases by 10 basis points. Everything else is remaining the same. So basically, there's no change in the front end, but intermediate. So short stays, long stays, but the intermediate changes. It's not level. Would it be curvature? Let's see. You've got the original, right? You've got middle coming down 10, but this one's staying the same, this one's staying the same. So I'd say curvature, because it's going to be curved now. Therefore, curvature only. So I would say B. In level, no change in slope. It is only the curvature that is changing. So there is this small downward change in the intermediate term yield, resulting in change in curvature depending on where it was before this movement. Okay, the next example. Typically, short-term rates tend to be.
I'm not stuck on the wall. My phone is charging. So I put it on the side.
More volatile than longer-term rates, and we'll explain.
Typically, short-term interest rates are more volatile. Yeah, we did say that. I need to do annualized volatility.
To you why in just just a little bit. So um, uh, for the time being, recognize that the volatility of short-term rates is higher than the volatility of long-term rates. All right. The next example, supposing you are given a portfolio that key rate changes are considered to be changes in the yield of 1 year, 5 year, and 10 year securities, and you are given the key rate duration for those. So D1, D2, and D3. D2 represents 5 years, D3 represents 10 years.
Oh, okay. So what's the formula for this? So change in P over P is equals to minus 0.5 times 50 plus minus 0.7 times 50 minus 0.9 times 50. Minus 105 minus 1.05%.
Now, what is the percentage change in a portfolio when all yields? So this is basically a parallel shift. I can basically calculate the impact based on duration. So sum of key rate duration is equal to 0.5 plus 0.7 plus 0.9, which gives me 2.10. So I'm kind of tempted to say that because yields are declining, so obviously the portfolio value should increase. So choice A is immediately out. We know that it should be a positive sign. Now, I may be tempted to go with option C, but remember here the declining yield curve is only 50 basis point, not 100 basis point. So it is half of 2.10, which is 1.05. And if you plug in our equation, you'll get to the same end result.
Oh, I got my signs wrong.
Maturity structure, as I already mentioned, short-term rates are more volatile than long-term rates, and obviously volatility in rates will drive price volatility. However, be aware though that because of the duration impact, remember change in yield times duration is equal to the percentage change in price. So because of the duration impact, the price of longer-term bonds tend to be more volatile than short-term, but the yields themselves are more volatile at the short end of this spectrum. Now, securities that have embedded option, and we have a whole reading on it. The option derives value from what? Volatility. An increase in yield volatility will increase the value of options that are embedded. Options that are dependent on interest rate are sensitive. The value is sensitive to interest rate. Those options, the volatility is positively correlated to the value of the option. Now, long maturity volatility is associated with uncertainty regarding the real economy, meaning GDP growth, and inflation uncertainty as well. So the two factors that influence the volatility of long spectrum is inflation and real economy. The short end is basically the uncertainty regarding monetary policy, meaning central bank actions. Now, there is a concept called as a bond risk premium. Oftentimes it is misunderstood. So what is bond risk premium? It is also called as duration premium or term premium. And it is simply the difference between expected return on a long-term government bond minus the risk-free rate. So if I purchase a 5-year government bond and I hold it for 1 year, what is my ex-ante return? What is my expected return? Not realized return, not the actual return after the end of the holding period, but on an ex-ante basis, I need to estimate what will be my return on that bond if I hold it for 1 year. And then from that, we subtract the risk. expiry rate. And so it, again, another label for this is term premium or duration premium. All right, now there are some terms that you need to be aware of. And one way to remember, now you have these labels bearish, bullish, and bullish. So one way to memorize this is to recognize this bearish and bullish refers to future state of the economy. So think of it as what will happen to the economy after some changes are made. Let's understand what I mean. So bearish flattening. This occurs by an increase in short-term rates. So think of it as a traditional upward sloping yield curve. Now short-term rates go up, long-term rates are unchanged. That leads to a flattening of the yield curve. Now, because of this action by the central bank, because of this monetary policy, I expect the economy to get into.
Wait, bearish flattening. So flattening means it's coming down. Bearish means it's at the back end of the curve. So the back end is coming down more than the front end, which means rates are going up on the front end. Okay. Bullish steepening. Steepening means it's going like this. Bullish means it's coming, oh, it means rates are coming down, but they're coming down more in the front. Yes. Okay. Fiscal policy expansionary causes increase in yields. Why? Because the central bank issues more, and when there's an increase in supply, the price of bonds falls. When the price of bonds falls, the yield increases. Maturity structure, demand supply in market segments, investor demand, flight to safety during times of crisis leads to a bullish flattening. What did you say about bullish flattening? We said flattening is when yields come down, and we said bullish is when the back end comes down more than the front end. Okay.
Growth mode, it will be good for the economy. And sorry, it will be bad for the economy because we are increasing short-term rate. So we are looking at bearish signs for the economy. As the monetary policy is contractionary, the economy will contract over time. The second type is bullish steepening, which is caused by a decrease in short-term rate. Now that is an expansionary monetary policy, and we are expecting the economy to grow rapidly after an expansionary monetary policy. So that is why we call it bullish. Other factors that affect the shape of the yield curve or changes in the shape of the yield curve include fiscal policy. So fiscal policy is the government's policy of taxing and spending. When the fiscal policy is expansionary, when, for example, the government's budget deficit widens, then that will lead to more borrowing by the government to fund those deficits that will increase yield. Another factor that influences the shape of the yield curve is simple segmented markets theory. Remember, where you have demand and supply in different segments, and the forces of demand and supply in different segments determines the shape of the yield curve. Finally, the last one is investor demand, and this is during the times of crisis. During those kind of times, there is something called a flight to safety, where riskier assets such as equities are liquidated and money is parked in government bonds. So this what it does is it will lead to an increase in demand at the long end of the yield curve, long-term government bonds, and that will push down the yield, leading to flattening. Now, they're labeled bullish is because as we come out of crisis mode, we are expecting the economy to recover. What are the actions that an investor can take in anticipation of changes in yield curve? Obviously, you want to decrease duration if you're expecting long-term rates to rise. Conversely, if the long-term rates are decreasing, you expect the investor to increase the duration of the portfolio. So simple as that, because duration magnifies the change in yield. Now,
if I think rates are going to rise, I'm decreasing duration because if rates rise, prices come down. Okay, so I want less interest rate exposure because my bond portfolio value is gonna come down. But if I think rates are gonna fall, then I want to increase duration, because the interest rate risk there, when rates fall, prices go up. So my portfolio, okay, so I want a higher exposure to that. Okay.
Bullet portfolio would be a portfolio that focuses on a single maturity. So, for example, your portfolio is concentrated in 10-year bonds. So that would be a bullet portfolio. It has basically a highest exposure to 10-year rates. Now, if you have a bullet portfolio and you're expecting bullish flattening, this is when during times of crisis, then it makes sense to basically take the bullet portfolio, convert it into barbell, where you are basically allocating to the two ends of the yield curve spectrum. So you take maybe half of your money in short term, half the money in long term. As the long term rates decrease, your portfolio return is enhanced, is increased. All right, let's look at an example on
That is
economic factors.
so fucking
So
difficult.
you're getting that Morgan Stanley is advising fixed income client. That is the current environment is recessionary. The bond yields is low and term structure is relatively flat. So
Morgan Stanley fixed income analyst responsible for advising fixed income clients about bond trading opportunities. In the current recessionary environment, the level of government bond yields is low and the term structure is nearly flat. Salaz's firm forecasts that after a brief recession, economic growth will quickly return during the coming 12 months. Okay. Which of the following changes to the yield curve is consistent with Salaz's expectation of increasing economic growth over the next coming year? So if they think economic growth is coming, that is, it means short-term rates are gonna come down. The yield curve is gonna steepen. So increasing the term spread. It's bullish, so decreasing the term of long over short. Yeah, the think rates is gonna come down. B.
now the firm is forecasting that after the brief recession, the growth will return in the next 12 months. Based on this background, which of the following changes to the yield
I
curve
think
is
it's bullish
consistent
steepening.
with increasing economic growth over the coming year? So choice A says decreasing level. And obviously that doesn't make sense, because if you're expecting economy to come out of recession, you are not expecting decrease in level of yield. The choice B is decrease in term spread, which is basically steepness of the yield curve, and choice C is increase in term spread. As your economy comes out of recession, short-term rates are currently dictated by monetary policy are low, as given to us, but the long-term rates are dependent on investor sentiment, and if the economy comes out of recession, the long-term rates will rise and will lead to increase in term spread. The second example, the Senate also expects that the Federal Reserve will start reducing purchase of assets of long-term bond.
If they decrease asset purchases, they are taking out liquidity, which decreases the supply, which will obviously increase the prices and decrease the yields. The reduced asset purchases will amplify, dampen the effect of increased economic activity on term rate. B, because they're taking out liquidity.
The government, the central bank, was basically participating in bond market to lower long-term rates to boost the economy. Now they are going to slow down this bond buying program as the economy recovers. Now the reduced asset purchases, what does it do? Remember the inverse relationship between price and yield. So when the government is not buying as many long-term assets, the demand for those assets will decrease, the price will decrease, and will have, because of inverse relationship, will amplify the term spread. Remember, term spread, based on market expectation of economic recovery, should lead to higher term spread, increase in steepness, and with this activity, it will further amplify, further enhance the term spread. So that is it for our content on the yield curve factors. Keep up the good work. Then
that nearly killed me. Right, after this it's gonna be, let me do the quiz, then I've got binomial. I want to go see what it's about, but all of the women in me are tired. That's the thing about gym. The least appropriate measure to use to identify and manage shaping risk in a portfolio is effective duration, because that's only for parallel Regarding the volatility term structure, research indicates that volatility in short-term rates is most strongly linked to uncertainty regarding monetary policy. Restrictive monetary policy is most likely to be associated with restrictive monetary policy means short end rates or front end rates are increasing. So if short end rates are increasing, that is either bearish flattening or bearish steepening. Yeah, bearish flattening. The yield curve is flattening. These rates are increasing. Yield curve is coming down, but the rates are increasing in the front more than at the back. Yeah, bearish flattening. Oh, I got 100%. There's a question bank for 23. It's gonna kill me. 70 minutes. Guys, I don't know if I can do that. I don't know if I have 70 minutes in me. Yeah, I think I did well this week. I did what? 80? Yeah, I'm on 18%. It's not where I need to be, but it's good. Okay. I've got 22 questions. Okay, let me do it. Let me do it. Get something for my lips first. Yeah. Let's do the questions. Okay. The active bond portfolio management strategy of rolling down the yield curve is most consistent with its liquidity preference theory. Given annual spot rates of those, the maximum number of forward rates that can be derived is closest to 1, 2, 3, 4. Maximum number of forward rates. I don't know how to do that. Let's draw it out. Okay, 0, 1, 2, 3, 4, 5. These are the spot rates I'm given. S1, S2, S3, S4, S5. So this is F1, F1. This is F2 for 1 year. This is F3 for 1 year. This is F4 for 1 year. 1, 2, 3, 4. I think it's 4. For 1 year. I guess for 1 year I can do F2 for 1 year. F3 for 1 year. F4 for 1 year. I guess I could also do here F4 for 2 years. Yeah, I could do F4. Well, F3 for 2 years. I could also do F2 for 3 years. I could also do F4 for 1 year. Okay. Here you could also do F2 for 2 years. You could also do F1 for 3 years. Then here you could also do, yeah, it's just F1, F1. Yeah. 1, 2, 3, 4. 1, 2, 3, 4, 5, 6, 7, 8, 9. Why am I getting 9? F1, F1, F2, F1. To get a 3, it can be F1. Oh, sorry, that's wrong. That's for 2, that's for 3. For 2, F1 of 1. For 3, I think it can be F2 of 1 or F1 of 2. F1 of 2. Yeah. For 3, it's, yeah, that's for 3. For this one, it's F1 of 3, F2 of 2, F3 of 1. For 5, we've got, that's why I'm getting myself confused. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm gonna say B. During the recent credit crisis in the country of Moldova, several money market funds reported large losses. Subsequently, the Moldovan regulatory body imposed strict restrictions on maturity of securities that money market funds could invest in. The reaction of Moldovan regulatory body was most likely based on a belief in preferred habitat theory, local exploitation theory, market segmentation. I think preferred habitat is it market segmentation? What did they say about the pensions? Which one was that? The pensions. We've got preferred habitat, local exploitations, liquidity, and segmented liquidity. Segmented market theory. A swap spread is the difference between the fixed rate and interest rate swap and interest. Yeah, fixed rate and interest rate swap and T-bill. Fixed rate and floating rate payments. MRR, the fixed rate and the swap. Yeah, it's the T-bill. Z spread is most accurately described as the constant that is added to get the fair value of a bond above the spot rate. So it's equal to the difference between the bond yields, added to the zero volatility binomial tree such that an option added to the spot rate curve to generate discount rates for each of the bond's cash flows, such that the present value of the cash flow is exactly equal to the market price of the bond. Yes. Compared to a yield curve based on government bonds, swap rate curves are more comparable across countries and with a smaller number of yields at various maturities. That's not true. More comparable across countries and have a greater number of yields at various maturities. AOC. Swap curves, they are more comparable, but I forgot. I think they have a greater, I think they're more liquid because they don't have more, because the government doesn't have on the run securities all the time. Joe McBeth makes the following two statements. One, the swap rate curve indicates credit spread over government yield. Yes. Swap rate curve indicates the premium for time value of money at different maturities. That's not true. The government bond yield curve indicates the premium for time value of money at different maturities. So statement one is correct. Volatility in short-term rates is most likely related to uncertainty about monetary policy. Which of the following statements are most accurate? Short-term rates are typically more volatile than long-term rates. Yes. Volatility of short-term rates and long-term rates is typically equal. No. Long-term rates are typically more volatile than short-term. No. 7.5%, 15-year annual coupon traded at a market price of that. The government spot is that. Suppose that the bond was callable in 10 years at par, and an analyst computed the Z spread on the bond ignoring an embedded option relative to the Z spread of an option free. The calculated Z spread will most likely be I think higher, because on an option free bond the Z spread is going to be 0 because you are taking away the interest rate volatility, which is what Z spread means. I think higher. I think on an option a bond with an option Z spread is 0. It is now January 1st. 1 year spot rate is that. 1 year forward rate for loan is that. Oh, the spot and the forward are equal. Current forward price of $1 0-point bond will most likely be it's not January 1st, 2017. Let me just see. I'm not getting this. 01 2016. 2017, sorry. Oh, let me bring in my clothes, it's raining. Guys, this thing is hard, hey? I've answered 10 questions in 12 minutes and I'm not confident about half of them. Okay, I've got 3 dates, no? 2017, 2018. They're saying the 1 year spot right now. Okay, so 2017 Jan. They're saying S1 is equals to F11, right? Which is the 2018 Jan. Okay. Oh no. It's F11 from 2016 Jan, which means the spot curve and the forward curve have exactly been the same. It hasn't changed. The current forward price for delivery in 2018 will most likely be, saying the 1 year spot rate now is exactly equal to the 1 year forward rate for a loan in 1 year as of there. The current price is that, oh, and it's the 1 year spot rate, so it will most likely be the same because the forward curve and the spot curve are exactly the same. Jim Malone, CIO of Sigma Bond Fund, has a successful track record of investing in investment-grade bonds. Recently, though, he has been lagging its peers. Sigma has been lagging its peers because Malone refuses to reduce the duration of the portfolio by purchasing short-term bonds for the fund. Malone's actions are most consistent with, I guess, preferred habitat theory. If the spot curve is upward sloping, the forward curve is most likely to be above. Definitely above and parallel to the spot curve and above the spot curve. Would it be steeper? Let's just see what that looks like. Yeah, this is tough. Yield, maturity. Let's say that is the spot curve. It's an upward sloping, which means the forward curve is definitely above it. It can't just be parallel. It doesn't have to be steeper. Yeah. When the yield curve is downward sloping, the TED spread is most likely to be we said TED spread is MRR minus it's 3-month market rate minus 3-month T-bill. And we said the yield curve is downward sloping. This is maturity. Fuck, this is hard. This is the yield. So we're saying 3-month market rate. The yield curve is downward sloping. The TED spread is most likely I don't know. I don't know how to think about that. Yeah, 3-month MRR minus 3-month T-bill. A rising TED spread is banks are increasingly likely to default on loans. A rising TED spread is falling liquidity. MRR is what large commercial banks charge each other for unsecured lending. If the spread is widening, it means liquidity conditions are poor in the market, or that are indicative of that. So if the yield curve is negative, it means, or not negative but downward sloping, it means it's cheaper to borrow in the back end than in the front end. But TED is still 3-month market rate minus 3-month T-bill. So I don't see how that would change. Still the market reference rate, I think it's still positive. Rising inflation in the economy is expanding could most likely lead to a so rising inflation needs interest rate hikes to contain. Then I do my drawing. That's my yield. That is my maturity. Then I've got the original curve. And if we hike front end interest rates more than back end, then you're gonna get, it's happening in the front, so it's bullish flattening. I think it's bullish flattening. Oh, sorry, it's bearish flattening. It's bullish, it means rates are coming down, and here it's bearish because rates are going up. It's flattening because they're coming up in the front. Bearish flattening. ASUN. Oh, it's gonna be a miracle if I pass this. According to the liquidity theory, how are forward rates interpreted? Forward rates are unbiased estimates of future spot rates. Yeah, it's expected future spot rates. Oh, English engaka. James Wallace, CFA, is a fixed income fund manager at a large investment firm. Each year, the firm recruits a group of 6 new college graduates in the spring to enter the firm's management training program. The program is a rigorous 6-month course that exposes every candidate to each of the different departments within the firm. After successfully completing the 6-month training period, candidates then receive offers for employment in one of the departments within the investment firm. Recently, Wallace was selected by his boss to teach the fixed income portion of the firm's training program. He will be able to hold several 2-hour sessions with the new hires over a 2-week time period, during which he is expected to instruct the trainees on all aspects of fixed income analysis. These sessions serve as preparation for the trainees to be able to complete a month-long rotation on the fixed income trading desk. His first few sessions will cover the core concepts of fixed income investing. Wallace believes that in order to fully grasp the more complicated concepts of fixed income analysis, the new hires must first begin by having a complete knowledge of the term structure and volatility of interest rates. The new hires each have different educational backgrounds and varying amounts of work experience, so Wallace decides to begin with the most basic concepts. What's that smell? He wants to start by teaching the various theories of the term structure of interest rates and the implications of each theory for the shape of the Treasury yield curve. To evaluate the trainee's understanding of the subjects at hand, he creates a series of questions. The following interest rate scenario is used to derive examples on the different theories used to explain the shape of the term structure. And for all of the company, we didn't need all that English. Wasting my time. Okay, you've got market reference rate being LIBOR. They give us the forward rates. You've got six-month LIBOR. Okay. Then they give us the implied spot rates. Okay. Following the lecture, he asked the trainees which of the following explains an upward sloping yield curve according to the unbiased pure expectations theory of the term structure of interest rates. A. There's a risk premium associated with more distant maturities. B. There's great demand for short-term securities than for long-term. C. The market expects short-term rates to rise through the relevant future. Pure expectations theory. It's definitely market expects short-term rates to rise through the relevant future. 2. Wallace now poses a similar question regarding the liquidity preference theory. Which of the following could explain an upward sloping yield curve according to the liquidity preference theory? A. There's greater demand for shorter term securities than longer term. There's a risk premium associated with more distant maturities. Yes. 19. Wallace presents the relationship between spot and forward according to the pure expectations theory. Which of the following is closest to the 1 year implied forward rate 1 year from now? One's F11. Okay, let me calculate that. Yeah. So I've got 0, I've got 0.5, I've got 1, I've got 1.5, I've got 2. I'm given S1, S0,5 is equals to 5. Ne? S1 is equals to 5,2498. Then S1,5 is equals to 5,4996. Then S2 is equals to 5,7492. Ne? Then I'm also given this is F 0,5. 0,5 is equals to 5%. Here F1 0,5 is equals to oh no, that one is 5, F1 to 0,5 is 6. Then F 1,5 0,5 6.5. Then F 2 0,5 6.75. Okay. Then which one are they asking for? F11. So you can hold for 1.5. It can be 1 plus S1, 5 or 1,5 is the same as holding 1 plus S1. Mm-mm. 1 plus S 0,5 and 1 plus F. Mm-mm. One plus S to 0,5 then 1 plus f naught comma 5. I need f1 of 1. Flip, this is hard. What makes up f1 of 1? That one's gonna be too small. One plus f1 of 1. No. I mean, you can get to S1. This can be 1 plus S2 squared. Well, let's try that. 5, 7.92 squared plus 5,2498. 1 plus. No. Wallace completes his first lecture by tying the relationship between treasury prices and the shape of the term structure. He is particularly interested in the implications of a steepening yield curve. Steepening yield curve, it's when short-term rates come down more than long end, so that is bullish steepening. Yeah, or it is when long dated go up more. So steepening is when there's a steepening, and then if it's bullish, it's rates coming down. If it's bearish, it's when they're going up. Okay. Which of the following is most accurate for a steepening yield curve? The price of long-term securities increases relative to the price of short-term securities. So that is steepening. Yeah. Price of short-term increases relative to, no, that's flattening. It's A. Ngasenkale for real. Price of 0, 1 default risk, 3 swap spread is closest to what maturity? I don't even have the swap rates. Those are the par bonds. From the par bonds, I can get the zeros. Then, if I've got the zeros, what am I gonna do? Once I've got the zeros, then I can compare I can price the 3-year. What's the steps? You get the zeros. I price. Do I need to price it? I get the zeros and then I compare it to the 3-year. government yield curve, and then I get the swap spread. Yeah, okay. Implies Z1 is equal to 9615, which implies Z1 is Z1 is 4%. 1 over I know I'm live. Why is it reminding me? Okay, I've got the zeros, which implies Z3 is 6% minus 5.25% is equals to 0.5% swap spread above government yield. Oh, that means that's wrong. I don't know how to do it. I feel like crying. I don't know how to do it. I don't know. I really don't know. I got 68%. I don't even know how. This thing is, it's barely charging. For that one, we said preferred habitat theory. What did we say? We said money market funds generally invest in short-term securities. The inclination to chase higher yields in the larger maturity spectrum is consistent with the preferred habitat theory, whereby investors will leave their preferred habitat if they are compensated by higher returns. If market segmentation theory held, investors would not have left their market segment and therefore no regulatory action would be necessary. Fuck, this feels like I'm doing ethics in English, Nje. If the spot curve is upward sloping, the forward curve is most likely above it. Digwe down. Price, not yield. That was a good one. Yeah. Okay. Oh, this is an easy one actually. The same swap fixed rate 3 is equals to 1 over 1 plus 1 plus S1. No? Oh, that's the discount factor. Plus 3 S2 squared. C'est la famille. And to think I wanted to cry, but I couldn't. Easy peasy. Whew. I'm so annoyed. This is so much work. Okay. So they gave me the par rates and I have to work out the 3-year spot rate. So I use bootstrapping to get the 2-year par rate or the 2-year spot rate, which I feed into the 3-year to get the 3-year spot rate. Next, fine. In 21, I was given discount factors essentially because they're all par bonds at 1. So they want the swap rate as well. So over there, I can just use the discount factors. Yeah. Because the par rates are in effect the discount factors. Here I'm not given the discount factors. I have to calculate them to get the spot curve. Here I'm given the discount to get the swap rate. Here I'm asked for the spot rate using bootstrapping. Okay, so that's the difference. Okay, I think I'm done for the day. All of the women in me are tired. 2302, 26. I think Spushi level fades. 22. 6. For tomorrow. Must remember to pack. Because I'm gonna start this at work tomorrow. Excellent, because I get in very early, like 6:30. The high, guys, I think I'm done. It says about 5.8 hours left of study, so it's gonna add on to next week's study, but I can't do any more. Just look at my performance track. I'm on 18% now. I've done 42 tasks this week, which is my highest. Yeah. Oh, question bank for fixed income, I'm at 68%. I'm at 65% for equants. I'm at 65% for ethics. Fixed income is my highest at 68. And I'm behind peers. Others are at 74%. So that's not good. Score difference with quants minus 10%, fixed income minus 6%, ethics minus 10%. But on time I'm quicker, which doesn't matter because I'm quicker, but I'm wrong. So yeah, exams I haven't started. Then yeah, look, there's nothing that I can just read while everything is just involved and in depth. So I mean, now the next thing I must do is study the nodes, binomial trees, then a master class on binomial trees, and then a quiz on binomial trees, and then part 2 a binomial trees again in notes in master class, and then interest rate models, and then a quiz on interest rate models, and then a question bank. So I'm a little bit tired, but if there was something nice and easy, I could go into it, but there's nothing nice and easy. All of it is fucking hard. Then there's types of embedded options. Then there's valuing bonds with embedded options. Then there's part 2 of valuing bonds with embedded options. Then there's OAS, so option adjusted spread. And then there's duration. Then there's key rate duration. Then there's capped and floored floaters. There's a lot of maths there again. Then there's convertible bonds. And then there's a master class on convertible bonds. Then there's credit risk measures. I suppose I could do credit risk measures, but yeah, I like the order in which they've said things. So let's see the outs. Introduction and theories of return. Analyzing returns and index construction. This is an alternatives. See, that's also difficult now. Then there's REITs. Then there's hedge funds. Hedge funds, the calculation of the performance fees is quite an interesting one. Yeah. So that's also not an easy read along. I mean, economics, I ran away from forex quotes, spreads, and triangular arbitrage. That thing messes with my mind. Exchange rates, that thing messes with me. And I like doing the quizzes when I'm ready and the question bank when I'm ready. So I don't want to waste my time and just do questions for what's name that I'm not ready for. Yeah, everything has to come together. So I'm happy with this. Maybe ethics, I can do something. I mean, there's a question bank for 45 minutes. But there's so much English for ethics. The questions are so big. Okay, it says it's 15 questions. Oh, but I'm tired, eh? I can't give it my best. Let me just let it go. Yeah, I think I did well this week. I did very well. Let's see what happens next week. I'm gonna hop off.